Hello students, this is Professor Vincent Osaya. Welcome to my class, and this is the presentation of part 2 of chapter 5, merchandising operations. This is where we left off in part 1. We were talking about the need to figure out the cost of goods or inventory on hand at the end of the year or at the end of the accounting period, and the cost of what we sold. And we say we have two systems to help us do that. The two systems are perpetual and periodic inventory systems. Now let's take a look at the definition of these two systems, a periodic inventory systems. We say that a periodic inventory system does not keep detailed running balance of inventory on a daily, weekly basis. What does that mean? So we buy bunch of inventory, we put it on the shelf, we sell, we buy inventory, we sell inventory. So as time progresses, we don't keep track on a continuous basis. So at the end of the month, or at the end of the quarter, or at the end of the year, however the case might be, when we are ready to prepare our financial statements, we need to determine the cost of goods sold, like we explained earlier, and we also need to determine the inventory, right? That is the ending inventory. So what do we have to do then? We have to stop, roll up our sleeves, and take a physical count of what is left. So if we have 100 items left, multiplied by $2 per unit, if that is what we paid for it, that would be $200, all right? So we said that is the ending inventory. Then we also figured out how many items or units we sold, and we multiply it by the unit cost price. That will also help us determine our cost of goods sold. So why do we call it periodic inventory system? Because periodically, monthly or quarterly or semi-annually, however the case might be, we stop and take a physical count to determine these two things, ending inventory and cost of goods sold. But take a look at the other method, perpetual inventory system. This system keeps track of inventory on a continuous basis. So how does that happen? We buy 1,000 items, we sell 100, automatically the system will update itself and say we have 900 left. We sell another 50, the system will let us know that we have 850 left, so on and so forth. If we go ahead and buy more product, we update the system. So we call it perpetual inventory system because the system that we have in place keeps ongoing record or continuous balance of inventory. So at any point in time, the computer or the system is able to tell us what the cost of goods sold is and what the inventory is at any point in time. Now, because of the advancement in information technology, and because almost every company can afford a computer, a lot of companies now mechanize or computerize their merchandise inventory. You know, for most of the time when you go to the department store and you buy stuff and they scan it, as soon as they scan it, their computer automatically record their cost of goods sold and also record their inventory and also update their records as to number of items that they have. So that is one of the reasons when you go to the store and you are looking for an item, they can go to their computer and tell you how many items of that particular product that they have left. So that is the perpetual inventory system. So that is the, moving along, let's take a look at the objective 2. Here we are going to account for the purchase of merchandise inventory using the perpetual inventory system. I want you to know here that for the remaining part of this chapter, we are going to zero in on perpetual inventory system, not the periodic, all right? And we are going to test you on the perpetual inventory system as well. Now, I want you to take a look at this. He said, account for this is important. Account for, another word for it in accounting is what? Record. Another word is recognize. Alright? So these three words are used interchangeably. Account for is the same thing as record or recognize a particular transaction. So how do we account for or record purchase of merchandise inventory using a perpetual inventory system? So what we are doing here is we are utilizing perpetual inventory system and we are accounting for the purchase of merchandise inventory. What does that mean? Take a look at example, Walmart. Walmart has to go out there and purchase inventory so that they can store up the inventory for customers. So how do we account for that? So the following transactions are relating to how to do that. So before we get into that, I want you to show you a purchase invoice. Now, what is a purchase invoice? A purchase invoice is a source document. What do we mean by a source document? Example would be a receipt. If you buy something, they give you a receipt, that is a source document. Now, this is very important because an accountant will record transaction not from top of his head, but based on a source document. What does that mean? In other words, we use the source document as a basis to record transaction in the journal ledger. All right. So here is a purchase invoice. So I want you to go ahead and pay close attention to the details or the pieces that makes up the purchase invoice or different parts of the purchase invoice. Number one, that is the seller and the address. Number two, the company that is purchasing the inventory, so on and so forth. Another important thing that I want to draw to your attention here is this: credit terms. Credit terms, this is a conventional business term that we use. It said here 315 next 30 days. What does that mean? That means if the purchaser pays within 15 days, you get 3% discount. Otherwise, the total amount is due in 30 days. So those are what we mean. That is the definition or the explanation of that credit terms. So I encourage you to take a look at these closely in details. So moving along, let's take a look at the first transaction. What are we doing here? Here, the merchandiser or the merchandise company is purchasing inventory. Why do you have to do that? Of course, Walmart needs to purchase a lot of inventory in order for Walmart to be in business, in order for customers to go in and buy whatever they need to buy. So here, Smart Touch received goods on June 3rd and makes a payment on that day. So this company did not only receive goods right away, the goods were paid for right away. So this is more or less like how do you say, cash on delivery. There's another term. But anyhow, so cash is being paid for the inventory right away. So the most important thing here is how do we record it? So the company that purchased it, that is the merchandise company, did what? Debit merchandise inventory. Why? Because merchandise inventory is an asset. An asset goes up for $35,000 and cash is credited because cash goes down for $35,000. Moving along, let's take a look at the next transaction. Same thing. In this case, the company did not pay cash, right? So the company debit merchandise inventory for $35,000 instead of cash. Accounts payable is credited for $35,000. Moving along, purchase discount. What does that mean? Purchase discount is given to the purchaser by the seller as an incentive to pay early. Okay, so look at what happened here. Remember we talked about the credit terms. The credit terms is 3-15. 3 means 3% if you pay within 15 days, net 30 days. Otherwise, the full amount is due in 30 days. So take a look at this company pays within the discount period. So instead of paying the full 35,000, the company is only paying 97% of 35,000, or 3% of 35,000 is 1050. That is the discount that this company is getting. The difference between 1050 and 35,000 is 33,900. So take a look at, the company pays only 33,950, and merchandise inventory is credited for 1050. So the discount decreases the cost of merchandise inventory for the merchandise company. And of course, we debit accounts payable because we are no longer responsible for paying 35,000. We pay less because of the discount. So that is how you account for purchase discount. Now moving along, here is another transaction relative to a merchandise company dealing with his vendors, okay? We call these purchase returns and allowances. There are two things going on here, all right? Two things. We have purchase returns, we have allowances. You need to understand the explanation of these. What do you mean by purchase returns? So take a look at this. Assuming that all of us in this classroom have a merchandise business and we buy goods from New York. So we buy all these clothes from New York, and guess what? We receive the clothes or goods, and some of them did not meet our specifications. So we return them back to New York. So we call that purchase returns. Sometimes we call New York and say, listen, some of these goods did not meet our specification, or some of these goods are defective or whatever. And the company in New York that we are dealing with said, don't bring them back. Keep them and find a way to sell them the way they are. However, instead of you paying $10 per unit, just pay us $7 per unit. So they are giving us allowance. So there are two different things. Either way, the net effect is the same. I also want to introduce another term here that we probably have not talked about. That is, let's assume that we have a company in Chicago, and this company is a merchandise company. The party that we are buying our goods from, in business we call that party a vendor or a supplier. But a vendor is a generic name for every other person or company that we deal with that sells stuff to us or that provides services to us. So for example, AT&T, ComEd, our supplier in New York, our plumbing company that help us to fix our toilet when our toilet is messed up. All these companies that we deal with, we call them vendors, okay? So, thus far, we are talking about the relationship between our supplier or vendor in connection with purchases, okay? Now, moving along, the question is, how do we account for purchases, returns, and allowances? So take a look at what happened here. So this company returns $7,000 of the inventory that they bought. Because we are returning $7,000, we are no longer obligated to pay $35,000. So we have to debit our accounts payable for $7,000. By debiting accounts payable, what happens to accounts payable? We are reducing it because accounts payable is a liability. A debit to liability is a reduction. Again, don't forget your debit and credit rules. If you don't get them by now, you should go back to chapters 2, 3 and learn those debit and credit rules thoroughly. So with debit accounts payable, take a look at what happened. We credit merchandise inventory. By crediting merchandise inventory, we are reducing merchandise inventory. Why? Because we return some of the goods that we bought. So we return them to the seller. So those are the seller in New York. I don't want to use the word seller. I'd rather use the word vendor or supplier. You are going to see why I don't want to use the word seller. We are the purchaser. So the people that we are buying from, actually we call them the seller. But I rather just keep it vendor. Moving along, let's take a look at the transportation cost. Now, transportation cost is part of the cost of inventory. I think at this point in time, we need to stop right here for part 2. So this will be the conclusion of part 2, and we will take it from